Welcome back, everybody. Today, we're going to be taking a deep dive into something I think you're all pretty familiar with. U.S. tax exemption for nonprofits. But as you know, navigating this world can get pretty complex.
Definitely. And it's not just about understanding the rules, it's about seeing how they fit into the bigger picture
Yeah.
of a nonprofit's journey.
Exactly. So we're going to be using excerpts from the IRS publication 557, that dense, but essential guide to break down everything from qualifying for tax exemption to the ongoing responsibilities that come with it. And we're also going to be exploring how the digital age is shaking things up,
Yes.
forcing us to rethink some of those long-standing rules.
Yeah, it's so fascinating to see how the IRS is adapting to things like cryptocurrency donations and online fundraising platforms.
That's good.
Before we get ahead of ourselves, let's start at the beginning. What does it actually mean to be tax exempt in the US?
Yeah, that's a good question. It sounds straightforward enough, but I bet there are nuances that we might miss.
Absolutely. So the first thing to understand is that this tax-exempt status refers specifically to federal income tax, not state or local taxes. And it's not a blanket exemption for every activity a nonprofit might engage in.
Right. So it's more targeted than many people might initially think.
Exactly. And not all organizations are required to go through the same process. Churches, for example, are automatically exempt under Section 501c3. But for other organizations, especially those involved in charitable, educational, or scientific work, the journey starts with an application.
That makes sense. It seems like the IRS wants to make sure organizations truly align with the spirit of tax exemption before granting that status. Speaking of the application process, I've heard there are different forms depending on the organization's size and structure.
You're right. There's the comprehensive form 1023, which is the standard application. And then there's the streamlined form 1023EZ, which is designed for smaller organizations. And here's a key change that happened a few years ago. All applications must now be submitted electronically through pay.gov.
Oh, that's interesting. I'm curious what prompted that shift to electronic filing.
Efficiency mostly. It allows the IRS to process applications faster, reduces paperwork,
Mm.
and minimizes errors. But it also highlights a broader trend. The IRS, like many organizations, is increasingly embracing technology in its operations.
So this move to electronic filing was kind of a foreshadowing of the digital transformation we're seeing across the nonprofit sector.
Precisely. And as we'll see later, this digital shift is raising a lot of interesting questions about transparency, accountability, and how the IRS will need to adapt its rules to keep pace.
Okay. Now, before we get too deep into the future, let's go back to the application process. What are some of the key differences between the 1023 and the 1023EZ, besides the length, obviously?
Well, the 1023EZ is designed for organizations with projected annual gross receipts of less than $50,000 and assets under $250,000. It asks fewer questions and requires less documentation, but it's crucial for organizations to carefully determine their eligibility before choosing the EZ route, because using the wrong form can lead to delays or even rejection.
Gotcha. So while the easy form might seem appealing, it's not a shortcut for everyone.
Exactly. It's about finding the right fit for your organization's specific circumstances. And speaking of fitting in, let's talk about a unique concept, group exemption.
Yeah. I've heard that term before, but I'm not entirely sure what it entails. Can you break it down for us?
Of course, think of it this way. You have a national organization, let's say the American Red Cross, which acts as the central organization. Then you have local chapters all across the country. These are considered subordinate organizations. Group exemption allows the central organization to apply for a single exemption letter that covers all of its subordinate chapters.
That sounds incredibly efficient. It must save a lot of paperwork and administrative headaches.
It does.
Mm.
But there's a catch. As of 2020, the IRS put a hold on accepting new requests for group exemption letters. They haven't given a clear timeline for when this will change, so organizations hoping to take advantage of this option are in a bit of limbo.
Wow, that's surprising. What led to that decision?
It's not entirely clear. The IRS cited administrative reasons, but many speculate that they're reevaluating the group exemption process, perhaps looking for ways to modernize it or address potential concerns about oversight.
So this temporary hold could actually be a sign of things to come, potentially even a precursor to broader changes in how the IRS manages exemptions in the future.
That's a very astute observation. It definitely speaks to the dynamic nature of this field, how even long-standing practices are subject to review and revision as the landscape evolves.
Yeah, it seems like staying informed is key, especially with these unexpected twists and turns. Now, let's say an organization has successfully navigated the application process and secured that coveted tax-exempt status. Are they home free?
Not quite. Maintaining tax-exempt status comes with its own set of responsibilities, particularly when it comes to filing requirements.
Yeah, yes. The paperwork never really ends, does it?
Unfortunately not. Most exempt organizations, even those small enough to use the 1023EZ, have annual filing obligations. And there are consequences for failing to comply.
Okay, this is where it gets really important. What are those filing requirements? And what happens if an organization drops the ball?
So you're telling me that even if an organization is out there doing amazing work, fulfilling its mission, they could still lose their tax-exempt status just because of a paperwork mishap.
Yeah, it seems kind of crazy, right?
It's true. The IRS is very strict about filing deadlines. Most organizations are required to file an annual Form 990, which provides detailed financial information and details about their activities. However, for the smallest organizations, those with gross receipts under $50,000, there's a simpler option, the Form 990N, often referred to as the e-postcard.
Okay, the e-postcard. That sounds a lot less intimidating than a full-blown 990. What kind of information does the e-postcard require?
It's very basic. Things like the organization's name, address, employer identification number, EIN, and a statement confirming that their gross receipts are below the threshold. The goal is to streamline reporting for these smaller nonprofits, recognizing that their operations might be less complex.
That makes sense. It's about tailoring the requirements to the scale of the organization. But what happens if an organization, regardless of size, fails to meet these filing deadlines?
The consequences can be severe. If an organization fails to file the required forms for 3 consecutive years, the IRS can automatically revoke its tax-exempt status.
Wow, 3 years. That seems surprisingly lenient. You'd think they'd crack down sooner.
You'd be surprised how often organizations fall behind on their filings. Sometimes due to simple oversight or lack of resources, the 3-year rule gives them a chance to get back on track before facing that ultimate penalty. But it's a reminder that compliance is an ongoing responsibility, not a one-time hurdle.
Definitely a wake-up call for any nonprofits listening. Now,
Yeah.
we've talked about the core requirements for maintaining tax-exempt status, but I know there are other areas where things can get tricky. One that comes to mind is the concept of unrelated business income. What exactly does that mean, and why should nonprofits be concerned about it?
Yeah, it's a common point of confusion. Essentially, unrelated business income, or UBTI, applies when a nonprofit engages in activities that generate income, but are not directly related to their core exempt purpose.
Okay, can you give us a real-world example to illustrate this?
Absolutely. Imagine a university that owns a large parking garage. The university's primary purpose is education, but they also generate income by renting parking spaces to the public. This parking income, because it's not directly related to their educational mission, could be considered UBTI.
So even though the parking garage is owned by a nonprofit university, the income it generates might be subject to taxation.
Exactly. And here's where it gets interesting. The IRS has specific rules for determining whether an activity generates UBTI. It looks at factors like the regularity of the activity, the purpose behind it, and whether it competes with for-profit businesses.
It sounds like there's a lot of nuance involved, and perhaps some gray areas that could lead to disputes with the IRS.
You're right. And it's not just about whether an activity generates UBTI, but also how much. If an organization's UBTI exceeds $1,000 in a given year, they're required to file Form 990T to report this income and potentially pay taxes on it.
So even if a nonprofit is primarily focused on its tax-exempt mission, it still needs to be aware of these potential income streams
Yeah.
and how they might impact its tax obligations.
Precisely. And to add another layer of complexity, there was a significant change in 2018. Organizations with multiple unrelated businesses must now calculate UBTI separately for each business.
So let's say our hypothetical university also has a bookstore that sells merchandise to the public. That bookstore's income would be calculated separately from the parking garage income when determining UBTI.
You got it. Each unrelated business is treated as its own entity for tax purposes. This change highlights the importance of careful record-keeping and accounting practices for nonprofits, especially those with diverse income streams.
It sounds like navigating the world of UBTI requires a deep understanding of the IRS rules and the ability to apply them to specific situations. It also raises questions about transparency. How much of this information is available to the public?
That's a great question. And it brings us to a crucial aspect of tax exemption, public disclosure requirements. The IRS takes transparency very seriously, and there are specific rules governing what information nonprofits must make available to the public.
Okay, so it's not just about complying with internal regulations. It's also about ensuring public accountability. What kind of information is typically subject to public disclosure?
Most of the information a nonprofit submits to the IRS, particularly in their application for tax-exempt status, is considered public record. This includes their governing documents, financial statements, and details about their activities. Anyone can request to inspect these documents, although there are some exceptions to protect sensitive information.
What about those exceptions? What kind of information is typically shielded from public view?
One key exception is the names and addresses of individual donors to nonprofits, particularly those classified as public charities. This confidentiality is designed to protect donor privacy and encourage charitable giving. However, there are situations where donor information might be disclosed, such as in cases of legal investigations or audits.
So while transparency is paramount, there's also a recognition of the need to balance it with privacy concerns, especially when it comes to individual donors.
Absolutely. It's a delicate balancing act. But it's important to note that even with these exceptions, there's a high level of transparency when it comes to nonprofit finances. For example, Form 990, which provides a comprehensive overview of a nonprofit's financial activities, is available for public inspection.
Right. The public has a right to know how these organizations which benefit from tax exemptions are managing their resources.
Exactly. And this transparency extends to unrelated business income as well. Form 990-, which we discussed earlier, is always public, even for organizations that don't typically file a full 990.
So going back to our university example, anyone could potentially request to see how much income the university is generating from its parking garage or bookstore.
That's correct. This public disclosure ensures accountability and helps prevent abuse of the tax-exempt system. And there are consequences for nonprofits that fail to comply with these transparency requirements.
What kind of penalties are we talking about?
Failure to comply with public inspection rules can result in a penalty of $20 per day. And if an organization intentionally disregards these rules, they could face more severe penalties, including potential revocation of their tax-exempt status.
Wow. $20 per day can add up quickly. It seems like the IRS really wants to emphasize the importance of transparency and make it clear that there are real consequences for hiding information from the public.
Absolutely. Transparency is a cornerstone of the tax-exempt system, and the IRS has a variety of mechanisms in place to enforce it.
Now, beyond these core filing and disclosure requirements, are there other potential pitfalls that nonprofits should be aware of?
Oh, there are quite a few. One area that often trips up organizations is the requirement to make certain disclosures about their activities, especially when it comes to lobbying or political campaigning.
Right. This is an area I know can be tricky for nonprofits.
Yeah.
They want to advocate for their cause, but also need to be mindful of the rules governing their tax-exempt status. What kind of disclosures are we talking about?
For example, organizations that engage in lobbying activities must clearly disclose to donors whether their contributions are tax-deductible or not. This is because donations used for lobbying purposes are generally not tax-deductible.
So it's about being upfront with donors
Mhm.
and ensuring they understand the tax implications of their contributions.
Exactly. And there are similar disclosure requirements for organizations that engage in political campaign activities. The IRS has strict rules governing what types of political activities are permissible for nonprofits and how those activities must be reported.
It sounds like navigating this area requires careful attention to detail and a thorough understanding of the IRS guidelines.
It does, and the penalties for violating these rules can be significant, potentially including fines and even revocation of tax-exempt status.
So it's clear that maintaining compliance with the IRS rules is an ongoing process for nonprofits. It's not just about securing that initial tax-exempt status, but also about staying informed and adapting to changes in the regulatory landscape.
You've hit the nail on the head. The landscape is constantly evolving, and the IRS is constantly refining its rules and guidance. This is especially true in the digital age, where new technologies and fundraising methods are emerging all the time.
That's a great point. We've covered a lot of ground today, from the fundamentals of tax exemption to the nuances of unrelated business income and public disclosure requirements. But as you mentioned earlier, the digital revolution is shaking things up and forcing us to rethink some of these long-standing practices.
Yeah, it's a fascinating time to be involved in the nonprofit world. We're seeing a convergence of traditional regulatory frameworks and cutting-edge technologies, and it's creating both challenges and opportunities for organizations.
And those challenges and opportunities are precisely what we'll be exploring in the final part of our deep dive. So let's dive into this digital wave that's washing over the nonprofit sector. What are some of the biggest challenges organizations are facing when it comes to compliance in this new landscape?
Well, one of the most pressing issues is the rise of online fundraising platforms and the complexities they introduce. Think about platforms like GoFundMe or Patreon, where individuals can easily solicit donations for a wide range of causes. While these platforms offer incredible opportunities for nonprofits to reach broader audiences and raise funds quickly, they also create challenges for ensuring transparency and accountability.
I can see that. When donations are pouring in from multiple sources, potentially even anonymously, it can be difficult to track everything and ensure compliance with IRS regulations.
Exactly. The IRS relies heavily on organizations accurately self-reporting their income and activities. But the decentralized nature of online fundraising can make this more difficult. For example, if a nonprofit receives numerous small donations through a platform like PayPal, it might be challenging to reconcile those transactions with their overall accounting records.
So it sounds like the IRS might need to adapt its reporting requirements to account for these new avenues of fundraising.
They're already starting to. There have been discussions about requiring online platforms to play a more active role in collecting and reporting data on donations made through their systems. This could potentially streamline the process for nonprofits, but also raises questions about privacy and data security.
It's a complex issue with a lot of moving parts. And it's not just about online platforms. There's a whole new world of digital assets and currencies that are entering the philanthropic space.
You're thinking about cryptocurrency, right?
It's exactly. I've seen more and more nonprofits accepting donations in Bitcoin, Ethereum, and other cryptocurrencies. It seems like a natural evolution given how popular these digital currencies have become. But how is the IRS approaching this from a regulatory standpoint?
It's still a bit of a gray area, which can be frustrating for nonprofits trying to navigate these uncharted waters. The IRS has issued some guidance on how to treat cryptocurrency donations for tax purposes, but there's still a lot of uncertainty about valuation reporting requirements and potential tax implications for both the donor and the recipient.
So it's a case of the technology outpacing the regulations.
In many ways, yes, and it highlights the need for ongoing dialogue between the nonprofit sector, the IRS, and technology experts to develop clear and consistent guidelines that promote both innovation and accountability.
It sounds like there's a lot of work to be done to ensure that the regulatory framework keeps pace with the rapid evolution of the digital landscape. But beyond the technical challenges, are there other broader implications of this digital shift for nonprofits?
Absolutely. One significant impact is the increased focus on transparency and the potential for greater public scrutiny. In the past, nonprofit financial information was often accessible only through formal requests or by reviewing publicly available documents. But with the rise of online databases, social media, and data analysis tools, it's becoming much easier for anyone to track a nonprofit's financial activities, including their sources of income and how they're spending their funds.
So it's like the digital age is creating a more transparent environment for nonprofits, which could be both a blessing and a curse.
Exactly. On the one hand, it can enhance accountability and build trust with donors. When people can easily see how their contributions are being used, it can foster confidence and encourage continued support. But it also means nonprofits need to be even more diligent about their financial management practices and ensure they're prepared to answer questions and address concerns that might arise from this increased scrutiny.
It sounds like nonprofits need to be proactive, not just reactive. When it comes to transparency in the digital age,
I completely agree. It's not enough to simply comply with the minimum disclosure requirements.
Oh.
Organizations need to embrace transparency as a core value and find ways to communicate openly and effectively with their stakeholders about their financial activities.
So it's about going beyond the letter of the law and embracing the spirit of transparency. And it seems like technology itself can be a powerful tool for achieving this.
Absolutely. Nonprofits can leverage technology to create interactive online platforms that provide donors with real-time access to financial information, project updates, and impact reports. They can use social media to engage in open dialogue about their work and address questions or concerns directly.
It sounds like there's a real opportunity for nonprofits to leverage technology, not just for fundraising, but also for building trust and fostering deeper connections with their supporters.
Exactly. And as technology continues to evolve, we can expect even more innovative ways for nonprofits to demonstrate transparency and accountability. The organizations that embrace this digital transformation and find creative ways to engage with their stakeholders are likely to thrive in this new landscape.
Well, we've covered an incredible amount of ground today, from the nuts and bolts of tax exemption to the evolving challenges and opportunities of the digital age. As we wrap up our deep dive, what are some key takeaways you'd like to leave our listeners with?
I think the most important message is that knowledge is power. The more nonprofit leaders and staff understand about the rules governing tax exemption, the better equipped they'll be to navigate this complex landscape. And as we've discussed, this landscape is constantly shifting, so ongoing learning and adaptation are crucial.
Absolutely. It's not a one-time learning curve. It's a continuous journey.
Exactly. And remember, you don't have to navigate this journey alone. There are resources available to help, including the IRS website, specialized publications, and nonprofit consulting firms that can provide expert guidance.
Those are all great resources. And I'd add that networking with other nonprofit professionals can be incredibly valuable. Sharing experiences, best practices, and even just commiserating about the challenges can make a big difference.
I couldn't agree more. Building a strong network of support is essential for any nonprofit leader.
Well, listeners, we hope this deep dive has given you a solid foundation for understanding the world of U.S. tax exemption for nonprofit organizations. Remember, this is just the beginning of your exploration. Stay curious, stay informed, and most importantly, keep making a difference.